On January 9, 2026, a single post sent a shockwave through the financial world. President Trump announced a plan for a one-year, 10% cap on credit card interest rates. For the millions of Americans drowning in 25%, 29%, or even 36% APR, it sounds like a miracle. It sounds like freedom. But in the world of macroeconomics, there is no such thing as a free lunch. While a cap could save consumers an estimated $100 billion in interest, it could also trigger the greatest credit crunch we've seen in decades. Are the banks about to debank the American public? Or is this the affordability reset we've been waiting for? Today we're looking past the headlines to see what happens when the government puts a ceiling on the price of money. To understand why this is happening, we have to look at the current state of the American wallet. As of late 2025, total U.S. credit card debt has surged past $1.2 trillion. Under the status quo, if you have a $5,000 balance at 28% interest, which is now common, and you only make minimum payments, you aren't just paying for that TV or those groceries. You're paying for it 3 times over. It can take 24 years to pay off that debt, costing you $11,000 in interest alone. Trump's argument is simple. This is extortion. By capping that rate at 10%, that $11,000 interest bill drops to roughly $3,700. That's more than $7,000 staying in the consumer's pocket. It's an immediate injection of liquidity into the middle class. But this is where the simple part ends. Within hours of the announcement, the banking industry issued a collective warning. The American Bankers Association and the Bank Policy Institute didn't mince words. They called it devastating. Why? Because banks aren't charities. They price interest based on risk. When a bank lends money via a credit card, there's no collateral. Unlike your car loan or your mortgage, if you stop paying your credit card, the bank can't repossess the dinner you bought last Tuesday. To cover the people who default, they charge higher rates to everyone else. If the government says you can only charge 10%, the bank's math suddenly stops working. Billionaire investor Bill Ackman warned that if banks can't charge enough to cover their losses, they won't just lower the rates, they will cancel the cards. This brings us to the most dangerous consequence, the credit crunch. If you have an 800 credit score, you're safe. You're likely already paying lower rates or paying in full. But what about the subprime or near-prime borrowers? These are the people with scores between 580 and 660. Analysts suggest that a 10% cap would make it mathematically impossible for banks to lend to this group. We could see 14 to 15 million households lose access to credit entirely. Think about that. If you rely on your credit card for an emergency car repair or a medical bill, and that card is suddenly closed because the bank can no longer profitably take a risk on you, where do you go? You go to the only people left. Payday lenders and loan sharks, where rates aren't 28%, they're 400%. And for those of you who pay your balance every month and love your travel points, don't think you're immune. Those free flights to Hawaii and 3% cashback rewards are funded largely by the massive interest revenue banks collect from other users. If that revenue stream is cut by 60%, the rewards programs are the first thing on the chopping block. We saw this happen in 2010 with the Durbin Amendment, which capped the fees banks could charge merchants for debit card swipes. Almost overnight, free checking disappeared at major banks, and debit rewards became a thing of the past. If the 10% cap goes live, your platinum card might become a very basic, very boring piece of plastic. Now, for the $100 billion question, is this even legal? President Trump wants this effective January 20th, 2026. But most legal experts, and even critics like Senator Elizabeth Warren, agree that a nationwide usury cap usually requires an act of Congress. There is already a bipartisan bill, sponsored by an unlikely duo, Bernie Sanders and Josh Hawley, that proposes this exact 10% cap. But passing it is a different story. The banking lobby is one of the most powerful in Washington. However, if the administration tries to use emergency executive powers or pressure the CFPB, Consumer Financial Protection Bureau, we are headed for a massive Supreme Court battle. The uncertainty alone could cause banks to tighten lending today in anticipation of the chaos tomorrow. So, is this a win for the little guy or a ticking time bomb? On one hand, the Vanderbilt Policy Accelerator released a study showing that banks actually can afford this. They argue that profit margins are thick enough to absorb the hit, especially if they just cut back on their multi-billion-dollar advertising budgets. On the other hand, the ripple effect the user mentioned is real. If banks stop lending, consumer spending, which accounts for 70% of the US economy, could freeze. If people can't borrow, they can't buy. If they don't buy, businesses fail. The 10% cap is the ultimate populist policy. It targets the pain of the average American, but it threatens the foundation of the financial system that the same Americans rely on. Whether this becomes law or remains a campaign-style threat, one thing is certain: the era of easy credit is changing. You need to be prepared. If you have high-interest debt, now is the time to look at consolidation or aggressive paydown strategies before the banks decide to debank your account. But what do you think? Is a 10% cap the relief we need, or are we about to see millions of Americans lose their financial safety net? Let me know in the comments below. Next step, since we're talking about debt, you might want to check out our latest video on the 15-year car loan trap to see how long-term loans are the other half of the affordability crisis.